Greetings, friends, and welcome to episode number 60 of the Financial Game Special Edition. You still haven't caught up to me, okay? You still haven't caught up to me, okay? You still haven't caught up to me yet, not at my age. With me, Jose Miguel Crespi.
I'm happy, really glad to be with you again to dive a bit into some topics that are very important and of great interest to the audience, which is the real estate market that we're looking at. We always contribute what in our business would be alternatives, specifically focused on real estate, as we mentioned in the previous episode. This involves constantly being in the market, analyzing data, and making project decisions. As a single family developer, you've been out in the field and visited sites at a point in the real estate cycle where important decisions and significant analysis are required. We are currently figuring out where to focus our efforts in order to effectively navigate and manage the complexities of the current economic environment. We've had a few days where rates have gone up, they've basically shot up, and as of today, according to Freddie Mac and Fannie Mae, we're looking at 6.50, 6.60. We've had a few days where rates have gone up, they've basically shot up, and as of today, according to Freddie Mac and Fannie Mae, we're looking at 6.50, 6.60, so always on average.
Almost always 2 percentage points higher for those friends who might not want to look, right? They see it like I do, since I don't have access. When I was in Japan or in Thailand, I did not have access to that data, so I would look at the benchmark, which is the 10-year, and you almost always add 200 basis points, 2 points, and more or less that is where it should be heading.
What decisions, Ferdinand, are you looking to make? How are you seeing the real estate market? How are you positioned? Give our followers an update. How are the real estate companies positioned? What are they looking at? What are they looking at?
Well, look, the shift has changed completely since the beginning of the year. In other words, the war has completely changed the business plan. We've had to throw it out and start over from scratch. That's the reality. What are the three main points? First, affordability. If it was difficult before, now it's going to be even worse. So we have to go back to the old playbook. Second, build to rent is now more effective than build to sell. Third, in the Southwest Florida area, incredibly, after touring the market yesterday, the Cape Coral market itself is better for build to sell than build to rent. Third, in the Southwest Florida area, incredibly, after touring the market yesterday, the Cape Coral market itself is better for build to sell than build to rent, regardless of the analysis she may have done. And that's why you have to be very careful when analyzing data, because you have to go all the way. You have to test and see the demand. Do you know what the absorption rate in Cape Coral has been over the last 4 months? That's important. Does that surprise me? 4.4. Red hot market. Okay. Red hot. Average 6.9, 6.8, 6.7. Yesterday it came out at 6.4. That's the overall market. But if you look and segment the data from the last 3 months, it's a market with a 4.3 absorption rate, a strong market. But if you look and segment the data from the last 3 months, it's a market with a 4.3 absorption rate, a strong market.
In Arachuela, the product is selling fast, much more rapidly than it would normally be expected to take.
Fourth, what's selling is from 1 million and up. What is selling is either from 1 million and up or from 450 and below. The territory I call the zone is between 550 and 750. Incredibly, days on the market for that segment are 90 days, 80 days. For over $1 million, it's 45 days on the market. For 450 or less, it's 38 days on the market. Days on the market for that segment are 90 days, 80 days. For over $1 million, it's 45 days on the market. For 450 or less, it's 38 days on the market. So it's really interesting when you look at the dynamics.
This means that for real estate alternatives today, if we want speed, the model has been adjusted in such a way that, thank you, it means we are now in that lower price range, right? We are in that lower price range, where the market is moving much faster. Where is the market moving faster?
Mostly what you're going to see is the $450,000 and below price range for sales. That market moves quickly because it's an important factor for rental prices. In the numbers we looked at, which were around $2,400 per month for an average new house, they have now dropped to $2,200 per month. This afternoon I have to work on redoing the pro forma, and I need to make sure I take all that new data into consideration. However, AI says the average is $2,400, but that's not true. It is $2,200, the amount that really moves quickly. Therefore, I need to perform several analyses regarding multiples, rates of return, and equity returns.
There is a great deal of cheerful and vibrant inventory.
In
Looking for rentals in the Southwest Florida area?
Florida, point number 7. Inventory has dropped by 26% in rentals and 60% in multifamily. The number of permits has decreased substantially. That's why the absorption rate has grown enormously, and the average price we saw at the bottom of the market, which was $360,000, is now at $390,000. Jose Miguel, in 6 months, that's an increase of almost 10%. The reason is, if you look at a market like Sarasota, where the median is $510,000. If you look at a market like Miami, if you look at a market like Fort Lauderdale, where the property taxes, believe it or not, are higher than in Miami-Dade, and you're talking about $500,000, well, there you have a new home with a pool. If you look at a market like Miami, if you look at a market like Fort Lauderdale, where the property taxes, believe it or not, are higher than in Miami-Dade, and you're talking about $500,000, well, there you have a new home with a pool on 10,000 square feet, which is 1,000 square meters in the world of metric land measurements. On 10,000 square feet, which is 1,000 square meters in the world of metric land measurements, for $390,000 or $400,000. And then you have property taxes at half the rate, you don't have an HOA, and the median price for a house in the United States is $425,000. And many times in the north, you don't have the same type of construction. Often in the north, you don't have the same type of construction. You don't have impact windows. You don't have tile. It's carpet, it's sticks, it's wood frames.
And not all of them are states.
Namely,
It's tax-free. You only pay the property tax.
well, right now, at this very moment, one of the major things I'm looking at is that you have the state of New York and other states, mainly like Illinois, Minnesota, and Michigan, which are all raising taxes and significantly raising property taxes. Now, even Mandami is looking at charging and increasing property taxes further. Then you look at California. I was recently in the city of Los Angeles, and I'll be very frank with you. The contrast when we came from Tokyo to Los Angeles is absolutely enormous. I mean, Los Angeles looks quite dirty. It looks very run down, and there are a lot of homeless people there, even more than you see in New York.
That's a problem for the entire state.
Well, I want to tell you that New York has now seen a 26% increase in the poverty rate, according to the latest study by Robin Hood Poverty. There are a number of macro factors, and now there's possibly a vote in November for the abolition of the property tax for a certain segment of the public. Thank you. That's going to...
That's going to be important.
important fact number 9. Important fact number 9. How much do you think the per capita income is in the Southwest Florida area?
In the latest study, I remember seeing it was higher than here on the East Coast, right? People earn more, right? Average per capita.
It's at $91,000. This is $91,000. Miami-Dade's per capita income is $60,000 to $58,000. And the national per capita income is $84,000.
So then the affordability issue should be less there. The affordability issue should be less there
Yes.
because they earn more.
Otherwise, if you look at the major cities in Florida like Tampa, the average price is $450,000 or even $475,000. If you go to Orlando, you're also talking about close to $500,000 or high 400,000s. If you go to Jacksonville, which is already the northernmost area, what is considered affordable luxury? You're looking at $450,000, $475,000. Well, if you can get $380,000, $390,000 and you have water, you have a beach. Well, if you can get $380,000, $390,000 and you have water, you have a beach.
That's great, Feria. That's great, but let's talk about two very important points that I think the audience is interested in. Let's talk about costs. What do you estimate or what do you think could really affect this situation? For example, I've been asked, hey, the oil situation, how could that affect construction costs? For example, I've been asked, hey, the oil situation, how could that affect construction costs? That
That seeps into all different types of materials, into various costs, into electrical equipment, and into construction materials. In other words, all of these will increase construction costs. That's why permitting activity is dropping substantially. Major builders have been shifting, slightly reducing home sizes in terms of space. But yes, that is going to have an effect on costs. I assume that we are going to see between a 10 and 12% increase in costs in terms of property manufacturing. And that is why we have taken matters into our own hands, where we are now creating our own crossings, lowering costs.
that's the hedge. That's a hedge.
We're also cutting square footage, reducing house sizes from 18 or 1900 square feet to around 1600 or 1625 in order to maintain a good margin. Now, the market is definitely favorable for Ford or Bolos because what you're seeing in detail is that on both sides, you have a house worth $1 million or more with water. You have access to the Gulf or water or a canal. So you have cookie cutter houses. Well, they're not exactly cookie cutter. It's just that they use slightly cheaper materials like in the carpeting. Typically, the way these houses are built is much more modest. And that type of house compared to the $1 million ones above, well, if you can give the client some added value, for example, right now we are thinking about installing new types of toilets. And that type of house compared to the $1 million ones above, well, if you can give the client some added value, for example, right now we're thinking about installing new types of toilets, don't laugh. Don't laugh. I was fascinated by the toilets in Japan. They're fabulous. They have everything. They're fabulous. They have everything. So I think one of the ideas, I was discussing it with Hugo yesterday, is that I'm thinking about having a series of things that set us apart, of course, in affordable luxury homes.
That's great.
And affordable luxury is about giving you little touches that aren't super luxurious, but that add extra value to a very desirable newly built property. But it adds extra value to a very desirable newly built property. And I think that unlike the luxury market, which is $1 million and up, it's very difficult to rent out a house worth $1 million or more. That's a lot of money you're committing and leaving tied up. Luxury has its place unless you do it at cost. But I think affordable luxury has the power to be sellable, but at the same time, if we need to rent, it can give us a good rental margin, specifically to be able to compete and maintain inventory in case we face a scenario like taxflation. But at the same time, if we need to rent, it can give us a good rental margin, specifically to be able to compete and sustain inventory in case we have a scenario like stagflation.
That is the reason why real estate should still be a part of your portfolio. You should have a portion in real estate because, as I have always said, it is manageable. You have various ways to hedge your risks, and you have ways to keep receiving consistent cash flow from those properties. In today's current market, people frequently discuss investing in multifamily properties for the same specific reason, because they are reliable assets that generate consistent income and are naturally anti-inflationary. In other words, as we continue to remain in an economy with high inflation, the rents in multifamily or single-family rental homes are also adjusted year after year to match the market. So there are many ways to invest in these tangible assets and to complement or supplement investment portfolios, which is what we have always recommended. Of course, it's important to have active management with management that makes important decisions, as you mentioned, Feridan. I think that's extremely important. In other words, if you can manage costs, if you can, right? Costs, if you can manage costs. For a builder, managing costs could mean having your own crew, as you mentioned, not subcontracting or not relying too much on subcontractors, because we know that as you subcontract, there are markups. Sometimes managing inventory of materials and products means you can buy in larger quantities. It's as simple as saying, oh, look, if we're going to build 5 houses of a certain model and all 5 houses use the same doors and windows, well, if we anticipate that the cost of doors and windows is going to go up, we buy them now in advance. That kind of management. Thank you. That kind of management is key right now, and for that reason, I still see that. Thank you. And for that reason, I still see that real estate, putting on my real estate hat, I see that real estate is doing well. It's highly recommended to maintain portions of your portfolio.
Well, the other part of the equation is payment facilities. I mean, how can you help that consumer? Because look, there's tremendous appetite and demand, Jose. For example, if a bank comes along and you have a credit score, let's suppose it's not optimal, but it's more or less decent, right? Let's say a 630, a 650, okay? Let's say a 630, a 650, okay? It's not super duper, but it's manageable. They're asking you for 15% or 20% down payment. They're asking you for 15% or 20% down payment. In Puerto Rico, they ask for more. In Puerto Rico, they ask for more. So, since you, the individual, have the income capacity but don't have the down payment, right now we're going to work on and launch a promotion for down payment assistance. Since you, the individual, have the income capacity but don't have the down payment, right now we're going to work on and launch a promotion for down payment assistance. We're going to get that prospect at least up to $15,000 in down payment assistance to give them the margin so they can acquire that property. We're providing options so that if they qualify with the bank and have good credit, we're willing to give them a rental contract for the first 4 months and we'll credit them 20% of that rent so that when they're ready for the bank, they'll already have their house, will have lived there, and will already have that overall pre-qualification experience. But if it turns out to be unnecessary, which it won't, you will be seen as a future buyer rather than just a renter. And that is the exact approach we are going to emphasize in the promotion.
Don't lose sight of something, and with this I'll finish my point, okay? The lock-in effect that was created in the post-pandemic period, right? The lock-in effect that was created in the post-pandemic period, right? When people were getting mortgages at 2.5 or 3%, those individuals, those families, today they still hold on, right? Today they still hold on, as they say, against the odds. They say, I'm against it, I have a 3%, and now I'm going to let this go out into the market. And based on how rates are today, they're closing at 6.5, 7%, or 6%, right? But keep in mind that this is cyclical, okay? Don't lose sight of the fact that this is cyclical, okay? The real estate market is cyclical. The real estate market is cyclical. And what's happening is the number of clients is increasing, those who are locked in, who have a 3% rate, but who are looking to move in the future, right? So when the cycle continues and we formally reach more average, more normal rates, so when the cycle continues and we formally reach more average, more normal rates, we don't have a crystal ball to say how long this will take, but it will happen because everything is cyclical. There will be a strong movement of inventory and in the market.
To be honest, the average mortgage rate is now between 6 and 7%. We're there. What happens is that people got very used to it. There are two factors. One reason is that housing prices went up very, very quickly, tremendously fast. And so 6% on $300,000 is not the same as 6% on $450,000. That's why you see the effect. But in terms of rates, if I look at it historically over the last 47 years, we're right there.
We are.
Average. What happened was that the situation became dislocated. Rates were kept artificially super low because of the COVID situation. And so what happened? Even with the property appreciating from $300,000 to $450,000, I can afford 3.5 or 4% financing. But when prices stay high and rates return to the average, that's when the complication arises, especially in terms of the down payment.
Excellent. Thank you, Felix. There's no more time, but we will continue to keep you informed.
Well, next time we might already be at 61 and 62, so we're still in the new chapters of the financial game. Next time we might already be at 61 and 62, so we're still in the new chapters of the new financial game. See
You next time.